Hey traders, Stephen Quitzel here with thetradersplan.com. Friday, October the 13th, so hope everything goes well. A couple quick announcements before I get started. I got a lot of charts to cover today. One, I'm going to be on vacation next week, so there's going to be no video blog. Two, I'm redoing a lot of things with my website, completely revamping it. Just about everything is being redone, so there might be some down links or some down pages, so I apologize for that. It's very short term. But I am updating everything definitely for the better. And number three, I just have the sniffles a little bit today. I have a head cold, so please excuse my voice. If I sniffle a little bit, I'll try not to, but I wanted to get this out to you guys so you guys could have some stuff to think about and chew on over the weekend before I go on vacation. So I hope this finds you very, very well, and I hope everybody has a wonderful weekend. Okay, so I really want to get started in stock charts. I just want to look at the S&P 500. You can see since the November surprise, the election, right? The market just went on a tear. And you got the green line is the 20-day moving average, and then you got the blue line, the 50, and then the 200-day. And I like to use moving averages a lot just as a trend line. So you can see that on the initial thrust, the market likes to stay above the 20-day moving average. Look at how long it kind of closed below it one day, but man, look at that. That is a major move. So then you have a pause and a sideways and a correction, and then you have a breakout. And then it came down and tested the breakout zone, and then it continues higher. Another one, breakout, comes back, tests that zone successfully. You can see that little bullish candle right there. And it creates a nice little cup with handle. I mean, this just looked right, okay? So when I drew this, I was like, is it going to finish the cup with handle? Question mark. Excuse me. Me personally, I thought it was going to roll over, but I've been saying that a lot. And just the market keeps climbing the wall of worry. So, as the market continues to chug higher, you definitely want to have a profit-taking rules on some of your positions, but you also want to have rules to keep you in as well. So I just use a simple sell half at, 8 to 10%, and then raise your stop to break even on the remaining half. That way, if the market just continues this major advance and it goes higher than any of us expected, you still have some in, and if it doesn't, you locked in some profits. So just simple trading plan rules to help you navigate the markets. And if you have a portfolio full of half positions like I do, well, that's a good thing because it means that all of my positions are working, right? I've locked in profits on all of them, and they're all just continuing to ride. So just make sure you be aware of that. So, excuse me. So you have the breakout, and, based on all these other moves, right? And I could probably draw a little percentage change on them. You had a nice little 3% move on this. You had about 2% move on this, and then you have about a 3% move on this. So probably likely this is going to, either create this, create a pullback, maybe create a deeper one. I don't know. I, like a lot of people, would have thought we would have had a correction a long time ago, and it just didn't happen. So all I'm saying is, based on all the previous patterns, it breaks out, the market goes 3-4%, and then it pulls back. So, if you're sitting on some cash, that's okay. Don't chase the market and let the market come to you. Looking at the Russell 2000, I love this chart. And why I love this chart is because it's sometimes the market, if you know what you're looking for, it really can be predictable. And I say that because the Russell 2000 went straight up, and that's mainly because, banks went straight up after the election. Look at this consolidation. I mean, this is basically from the beginning of December to September. So 8 months where the Russell 2000 didn't do anything. It just traded in this nice little box, right? Markets stair-stepped their way higher, and it tried to break out, and then it failed. But it came down and tested. Look at all this support around this 1350 area, and I thought this was going to crack, and it just charged so high since that. And then you have the relative ratio versus the S&P 500. So look at all these times that it tested this trend line, and then it finally broke through. And when this line is rising, it means the Russell small caps are outperforming the market, and when it's going down, it means it's underperforming the market. So during this sideways correction, it was underperforming the market. Then it breaks out and now starts to outperform. So is this the last hoorah before the market, gets that 5 to 10% correction or even more? I don't know. But I do know we are fairly extended right now. So make sure you have your rules in place if the market does go against you, that you're not riding, you're not doing what we call a round trip. And that's where it goes all the way up and then it comes all the way back to your buy price, right? You're taking profits along the way. So let's look at, actually, wait a minute. I didn't mean to do that. Let me kind of go back. I got lots of chart lists here. Give me just a second. Let me go find this. Let's look at some breadth. Okay, so, and this might be a little bit smaller on your screen, but you have and I got this from Arthur Hill. You have the small cap breadth, or the S&P 500 breadth, you have the mid cap breadth, and you have the small cap breadth. And this is the percentage of stocks above the 200-day moving average. And I do use breadth as a secondary indicator. So price and volume is the first indicator always, right? The rest of them are just secondary because you have a lot of these oscillators and momentum indicators that they're going to slow before the price breaks, but the price doesn't always break. During the major bull run of 2013, the S&P 500, the MACD, some of these indicators, they kept going down while the market just kept going up. So when the indicators start to go down, then you get a price break. That's when you need to take it seriously. But if the indicators are going down while the trend lines are still holding, then again, they're secondary, okay? So focus on the price first. But you can see, excuse me, you can see the S&P 500 breadth has stayed above 60% this whole time. That's pretty bullish. And right now, it's 75% of the S&P 500 stocks are above the 200-day moving average. It's incredibly bullish. There's nothing wrong there. The mid cap and small cap, you can see in August, it really corrected, just like the previous Russell 2000. It went under 60%, so it means we were in correction mode, at least for those indices. But the S&P 500 stayed bullish. So the S&P 500 is the 500-pound gorilla. The small caps and the large caps, they can move differently from each other, and they will a lot of the times. So just kind of keep that in mind. When the small caps really start to weaken, I start to pay attention, right? My eyes start to get a little big, and I just start to pay attention. But again, if the trend lines are still holding for the S&P 500, that's really what I focus on in the NASDAQ to make sure those trend lines are still intact. So that's what we want to focus on, right? We want to focus on the major market indices, and we want to focus on price before the secondary indicators. But a lot of times, these are good early warning signs. So sometimes, for example, when I see breadth really starting to weaken, but the trend lines in the S&P 500 are holding, I'm not going to go out and sell everything. But what I'll probably do is I'll probably just hold off on buying new positions until it corrects itself one way or another. So either the S&P 500 is going to come down to match that negative divergence in the small caps, or the small cap breadth like this is going to come back to match the strength in the S&P 500. So just a good rule of thumb, if you are seeing a lot of secondary indicators that are flashing yellow or red signals, but the major market index is intact, maybe you just hold off on buying new positions, but you keep your current positions until you get that price trend line break. So let's look at, I want to look at a world versus the S&P 500 chart. I can't seem to find it. Oh, there it is. Okay. So I've shown you this chart before. You have these periods, these extremely long periods where the world stocks and emerging markets outperform the S&P 500, and then you have these extremely long periods where the S&P 500 outperforms the world stocks. And why I think this is important, because if you're sitting on some long-term ETFs and an IRA like I am, you can quickly swap them out without having to be overly diversified. For example, if you're sitting in an SPY, what this is a relative ratio, the S&P 500 versus the all world stocks. So you can see from 2002 to 2008, world stocks and emerging markets just absolutely smoked the S&P 500. So you could have majorly overweighted world stocks and emerging markets, and you would have knocked the socks off the overall U.S. market. Then you have, some choppy action, and then the U.S. takes over. So when the relative ratio is rising, it means the S&P 500 is outperforming world stocks, okay? So, you want to pay attention to this, and a lot of times when this ratio is going up, this means the dollar is strengthening, which it has. And then when it goes down, see, this trend line cracked, meaning world stocks are starting to outperform the S&P 500, and look at how many times this trend line has been touched. I mean, 1, 2, 3, 4, 5, 6, 7, and then it breaks. So you need to take this break seriously. So the dollar's weakening and world stocks are starting to get stronger. Now, is this a shakeout or not? I don't know, but I tell you what I did with some long-term ETFs. I moved out of the US and I moved into some all-world ETFs, right? Just like a simple switch, because this outperformance is major, right? And when I say major, I mean, let's see what, so during this major bull run that the S&P 500 has beat world stocks, you can see the S&P 500 is up 90% versus the world stocks is up 15%. That's over a 7-year period. So when these trend lines break, I mean, would you rather be still sitting in world stocks, or would you rather be in 90% or 15%? So now these could potentially switch based on the market. So all I'm trying to say is, when the trend lines break, or when you start to get new leadership, you need to pay attention, because it can be significant. 90% versus 15% over a cumulative 7-year period, that can be significant. So your eyes need to pay attention, and you want to make sure that you're in the right sector, because that outperformance could really give you some outperformance in your overall portfolio over the next 5 to 10 years, that is. So, and if we look at the S&P 500, you can see during from 2002 to 2008, when world stocks and emerging markets outperformed, you can see the emerging markets returned 336% versus the S&P 500 49%. So let's just call it 50. So what would you rather have? If you're following the simple trend line, would you rather have 336% or 50% over a 6-7 year period? I think you'd rather have the 336%. So you just have some very simple rules and follow the relative ratio. Now, let's look at the S&P 500 versus the gold. It's getting interesting, and here's why it's getting interesting. Let me try to blow this up for you. Okay, so you had gold, from 2007 to really outperforming the S&P 500 until about 2012, 2011. So when the market's going down, or when the black line is going down, it means that the gold is outperforming the S&P 500, and when the line is going up, it means the S&P 500 is outperforming gold. Okay, so S&P 500 has been outperforming gold since the commodities really hit the tank in 2011. Trend line broke, means gold outperforms, and now this trend line is being tested, right? So if it gets tested and then this black line rolls over, it could mean a good long term for gold. But right now it's just hovering right here. So we need to pay attention. If this line breaks to the upside, right, I think that's very positive for stocks relative to gold. If it breaks to the downside, I think it's time to look at some more metals. So let me go look at a chart of gold. Okay, let me go over to another chart. So we're gonna look at price of gold. Let me pull up another chart list. Man, I got so many of them. Look at a lot of stuff. Okay, so I've been sending out this chart, and I want to keep revisiting it. So you got the GDX, the gold miners. Most people know this. Now this is GLD, right? And it broke out. So I found a little head and shoulders right here. It's pretty obvious. And then you got this downtrend line of the price of gold, and it broke out of this major downtrend line, and that is from mid 2016. So gold's been in a downtrend, creates bullish breakout, bullish couple of handles. And then it rolls back over. All right, so then it goes under the trend line and is coming back up. So it's not exact science. There's an art to it. So if this can turn up, I think this could be majorly bullish for gold. But, and here is the but. So we go down here. So there's a lot of things to factor in when you're looking at gold. So we got GDX, right, and these are the candles for GDX, and then you have the long-term downtrend, which matches the price of gold, right? We get that. Lots of failed breakouts on this downtrend. And then you have a successful breakout, a successful test, a successful move higher, and then a retracement down to the 200-day moving average. Okay. Here's where it gets interesting. Now it's starting to find support. So if this is support, I think gold could move significantly higher. I'm still kind of scratching my head on this one, and maybe I'm wrong, but when you go down here, so gold has got an inverse relationship with the dollar. So the dollar, this is the dollar, it's been going way, way down, and then finally it broke, kind of had a little mini consolidation, broke out. It's pulling back and is trying to test this breakout zone to see if we can get a bigger oversold bounce in the dollar. Now, if we get a 50% retracement in that dollar, it would bring us back to 25, 24, so around this area. If this breakout fails in the dollar, I think that's going to send gold higher. So I'm watching the dollar more than anything. So that's one thing to consider when saying if this breakout's going to work. And then you have GDX versus the GLD, so miners versus the metals. Relative ratio, you want the miners to outperform. That's a buy signal. So the miners broke out relative to the metal right here, so that's a buy signal. So if I look at a pure price action, the gold looks good, right? It's pulling back to support. The miners are outperforming the metals. The metal broke out of a head and shoulders downtrend line, is now reversing. Two things that are hesitating me on gold right now. One is the dollar, and it's testing this point. So if it does move higher, I do think that's going to cause this to roll over. But another thing, and this is something that you kind of have to do your own research sometimes. So what I did was I'm like, okay, if gold, if this is a major support for miners, there are going to be some miners out there that look incredibly bullish, or at least have some volume, have some accumulation. I just really couldn't find that, and that's what was missing. That's why I'm just hesitant on gold miners right now, even though technically everything looks right. Because I went out and looked at all the stocks within this ETF, and I'm like, okay, what stocks look bullish? At least what stocks have accumulation? That's really what I was looking at accumulation, because most of the charts are kind of bullish. There wasn't any volume that really is saying there's a heavy inflow into some of these gold stocks. It's just buying, but it's not heavy buying. So I might be over analyzing it, but I'm just going to kind of keep my eye on it right now. And maybe if this, continues to move up, and I can change my mind tomorrow. But yeah, I'm looking at the dollar for gold miners. I'm looking at the individual stocks, and the individual stocks are telling me that there's just not a lot of volume. Doesn't mean it can't go up. It just means there's not a lot of volume, which is kind of having me, hesitate just a little bit. So I just wanted to go through that. Let's look at a little bit of sectors right now. So energy is up today. Energy is leading. That's nice because I own a lot of energy stocks. So that's the intraday. But let's look at a 1 week chart to see what's leading. I want to look at the 1 week, 1 month, because I want to see where money is flowing, and then we're going to look at some individual stuff. So this week, utilities is leading. Consumer staples is leading. Those are defensive sectors, okay? So that's not incredibly bullish right there. That means that people are just getting a little cautious. It doesn't mean the market's going to roll over by any means. It just means that in the last week, these two sectors are leading. Consumer staples, your cereals, your beer, your recession-proof type stuff. I think people are going to buy more beer in a recession just because of hard times. And then you have utilities, which are high dividend paying stocks, and we all know that those are have a bearish tone. Energy is still incredibly strong, and we're going to look at some energy. Let's look at the 1 month chart. Where is the money really flowing? Okay, so industrials that's incredibly bullish to see the money in the last 1 month flowing into industrials, energy, and finance, okay? This is good for a lot of reasons. This is showing you the money rotation, okay? So mutual fund managers, pensions, institutions, they're going to rotate their money, right, into the industries and sectors that eventually have better valuations. Like they've been buying up the tech stocks. I mean, you got Amazon. I mean, the valuations are extreme for some of these technology companies. They look at rebalancing. They're like, okay, where can I find some value? They look at industrial and financials, because financials have actually underperformed. They're starting to outperform. They've underperformed all year. They've gone sideways. So And that is normal in a major bull market. You see this sector rotation, right? They're moving out of technology a little bit. And technology is still incredibly bullish, don't get me wrong. But you start to see slightly different leadership. So, you know, this is incredibly bullish, and you can see the three defensive sectors are towards the bottom in the last 1 month, even though in the last week they're going defensive. So, what I'm going to do is I'm going to dive deep in some individual stocks in the energy and the financial, because that's kind of what I like right now. So let me drag and drop. I'm going to drag this over to this screen. You know, let's go over to MarketSmith. I love it. Let's start with the ETF. So you got this XES, the Spider Oil and Gas Equipment ETF. So let's look at the daily chart first. And we actually bought some, or the newsletter bought some right here on the 18th, and then it went down a penny the next day, and then it just went straight up, okay? So it broke out of a major downtrend. So this cannot be, and this is like a 50% correction. So it broke out of a major downtrend, which is right at that 50-day moving average. That cannot be ignored. And I think we took some profits right here, and then we took some profits right here. And I think that was a good idea. But, you know, now if we look at this here, let me kind of get this line off and then I'll go back. Man, this is a kind of a bull flag right here. So and that's kind of an ugly flag, but this is something worth paying attention to. I would expect the 15 level to hold. I would. So if it comes down to here, and even if it comes down here hard, I think that's a buy signal. I think that's an opportunity and not a threat. So, and if it breaks out, I think that's a buy signal too. If it breaks below 15, I think you need to be careful and move out the way, because it probably means oil is getting weak, and this just could be a false rally. So, you know, looking at this XES, as long as the 15 holds, I think you're good. If you can get it somewhere in here, you know, put a stop under 15 or under this 50-day moving average, I think higher prices are to come in this sector. I don't know if the fundamentals match it. To me, it doesn't matter right now, but it's so oversold. This is just a major downtrend, and I think that I was listening to Greg Schnell at Stock Charts, and he made a really good point about like why he thinks the oil stocks can go higher. After, you know, the major, you know, top in oil was 100, and then it went down to, you know, 28 or something like that. You had a lot of these oil companies restructure their debt. They got really lean and really financially in a good position to be able to handle for the long-term $50 oil, if that is. So, you know, you have this major correction. A lot of these oil companies, man, they did what they had to do to survive, and they're coming out in good shape, or at least being able to handle major corrections in oil. So they're in better shape than they've ever been. And if the price of oil, from a margin standpoint, from, you know, not being too bloated, so if the price of oil goes up, they're going to go really high, just because of, you know, how well they turn their books around and aren't as bloated as they used to be. Now that's a theory, but it makes sense, right? So let's just look at some individual. Let's look at some individual oil stocks. This is EQGP. This is a pipeline. Nice little dividend. So if you're a dividend guy, it's got almost a 3% dividend. Here's why I like it. Now, it's an IPO, so it's sloppy. It is. This is sloppy, but why it's starting to get interesting, I'm going to talk about this in the banks. You have what I call, you know, you got the three base failure rule, where you have this consolidation, breakout, failure. You have, and then this consolidation, breakout, failure. And then you have this consolidation. I do believe when you have two consolidations in a row where the breakout fails and you have a third one that's starting to look a little leaner, that's a good thing, because all these failed breakouts, man, they've wore everybody out. And when they wear everybody out, that's typically a good sign for things to come higher. Now, why I like this is because I like shakeouts, because shakeouts just, they mentally wear people out. But you know, after 2 or 3 of those, man, they can really move. But look down here, look at all this accumulation that's stepping in on this third consolidation, and it just broke out. So I would say, I mean, I mean, if you're looking for a dividend paying stock in the oil, I mean, from an accumulation standpoint, look at these volume bars. That looks right. It does. So again, it's kind of sloppy, kind of ugly, but you know, you have a couple handle right here. It broke out on, tried to break out, and then it came back with above average volume, came down, tested the 20-day moving average. So again, breakout, shakeout, and now volume has really stepped in. Looks like 7 of the last 10 days. I mean, that's bullish right there. So might be one of my favorite ones just because I like the fact that it's shaking everybody out, and I like the fact that accumulation's coming into it. It makes sense. WG, I'm typically not a penny stock guy. This stock $3, but this is looking interesting. This was, if we look at the monthly chart, this is WG, by the way. This was once a $50 stock. So, and now it's 3. So, might come out leaner than ever. But look, it had a major downtrend, just like the XES we just looked at. Broke out. Let's see if it can pull out. You have finally had this is sales quarter with a positive sales quarter. So that's bullish. It's expected to get back on profitability in 2018. So this could be a turnaround story. And you can see the accumulation stepping in on the right side of this breakout. Now, what I'd be looking for on this stock is kind of a pullback to this cluster of moving averages. And we'll pull it up on the daily chart to kind of get maybe a closer look. But you have the golden cross that's about to happen right here. You got the 20-day moving average. It went from 2 to 330. But I look for kind of a deeper pullback because I'm not getting involved in something that goes straight up like that. But if it settles into it, I would expect this cluster of moving averages to hold it. And that could be major, especially after this major move and this major breakout. I would expect this to hold. So I think this could be a good play on maybe a little bit of a deeper pullback. Excuse me. All right, Valero. Look, look at the earnings over here. Year-over-year acceleration, 22%. Now, these are estimates this year, 30% next year. Return on equity, But look, 3 straight quarters of sales growth. After all these declines, you got 2 straight quarters of earnings growth. So you got to turn around, look at all this accumulation down here. And again, all these failed breakouts. Look, you have a consolidation right here. Breaks out, falls, another consolidation. Consolidation, breakout, falls. Then you got a double bottom, breakout, fails, and then it starts to tighten up right around here. So you can see all this sloppiness. Then it starts to tighten up, starts to accumulation. I would say a pullback. Let me get my tracker on here. Right now, it's about 9% above the 10-week moving average. I would try to get it, within 5%. So, it's the 10-week moving average is around 7150. So within 5% above that, I would think that would be a decent entry back around this pivot right here. What should happen, I think, and I've seen this stuff before, I think that this will ride the 10-week moving average for a nice little uptrend. Okay, so last oil stock, then we're going to look at some bank stocks. This Solaris Oilfield Infrastructure, SOI, look at the triple-digit earnings right there. 671% this year, 148%. Look at these sales growths. Man, it went from 3.6 to 13. I mean, that's triple-digit right there. That's serious. So, but it's a wild one. So you can see it broke out right here. This IPO consolidation came back, pulled back, tested support, the 10-week or the 50-day moving average, and then just lunged higher. So I'd say another pullback, somewhere in between here, that would be a bullish entry. Now let's look at some banks and let's look at we'll finish off with some banks. I'm going to show you something that's a little bit crazy. So you have banks and then you have the finance sector. Some of the brokers are outperforming banks. So let's just keep that in mind. Brokers and financial management, since the interest rates are starting to rise a little bit, are outperforming banks. So that's kind of where you want to have your money. I noticed this is JP. This is a Chinese finance investment company. So obviously there's more risk, but I mean, look at this, man. You know, you had this breakout and it is up 112% in 10 weeks from this breakout right here. Boy, that's strong. Now, I'm not telling you, and look over here, you got a nice return on equity. You got a pretty solid sales track record. So the sucker is growing pretty solid. 3 straight quarters, triple-digit earnings. It's probably already cooked in the price. Now, if we look at the daily chart, now I'm not telling you to buy this. Not even close. You want a hard pullback, and when this pulls back, it's going to be a hard pullback. But I mean, you want somewhere in between here. This 10-week or 50 days is going to catch up, and see if you can get it within that moving average. Because you can see so far on this move, it hadn't even broke the 20-day moving average, but it will. It will on a more deeper consolidation. So, you know, when it pulls back and when it pulls back hard, this is the strongest stock in the finance investment management. It's got the strongest earnings, and it's got the strongest relative strength. So I'm going to show you one more Chinese stock. Now here's why I'm showing in the finance sector. Here's why they got so incredibly strong. Look at all this accumulation in NOAA, right? You look at all this accumulation in NOAA. You got just this huge, massive consolidation, and then you got a failed breakout. And then failed breakout, and then the third one worked, right? So we talk about, 2 previous fail, and the third one worked. China just lowered their reserves, what banks need. So the theory goes that a lot of that money is going to find its way to the stock market. That's why I think these Chinese financial companies are going higher. So this thing has gone straight up, 22% in 2 weeks. It's got acceleration year-over-year earnings right there. It's got a very, very good return on equity. Look at that, from 25 to 40. So don't buy it here. Whatever you do, I mean, you really need to let it come in a little bit. But this is power, and it's major power. And there's going to be power to the upside, and there's going to be power to the downside. So I would just make sure that when you buy it on a pullback, that you try to buy it close to a moving average as possible, so you don't get shaken out. And if it breaks, you need to get out of these things. Let's look at some individual banks. The newsletter made, I think, about a 50% trade on this late last year, early this year. Bought it right around here and before the election, and then it just absolutely took off. So again, I'm looking for banks with, if you're looking for if you think, like I do, interest rates could enter a 20-year bull market like they've been in a 30-year bear market, right? Interest rates topped in 81 or 82. And when interest rates rise, and they've been going down, and, who knows if we're at the bottom now or if it needs to go a little lower. But, I think strategically, if you have, a 10 to 30-year time horizon, I think banks could be a good long-term investment. So what I like to do, and if you want to buy an individual bank and hold it for a long time and let that, 1 to 3% dividend just kind of keep reinvesting, I like to look at banks with high return on equities, because these are just well-run banks, well-run companies, solid track records of sales. Look at that, 26%, 22%. That is consistent. You got SFBS, by the way. Pretty good earnings. So when a bank has a return on equity of above 10%, that's pretty good, because it's kind of based on all the assets they have. It's kind of hard. But this is a stock that I like. It popped, it broke out of this downtrend, so I maybe just kind of let it pull in a little bit to the cluster of moving averages on a weekly chart, and that's not a bad play for you. One more broker that I missed on my list is this. This is a US-based SEIC is the ticker, but solid return on equity of 26%, acceleration in earnings. The sales aren't awesome, but look at all the accumulation that's stepping in. Again, I think this is going to ride the 10-week moving average, so you want to get it as close to the 10-week moving average as possible, because the stock is a little bit extended. So you want to see a pullback on this one. And last but not least, Bank of NT, Butterfield, NTB. This is a foreign bank, but again, the return on equity is huge, and I don't think I can really find a bank above that. And it's got acceleration. So when I look at fundamentals, I look at really 2 main things for fundamentals. for me, because I like growth stocks, I like to see year-over-year acceleration. So 9%, 21% next year is expected to be higher because Wall Street's always forward-looking. They're always going to look at what's next year, and they're going to price that in this year. So I like to see year-over-year, and I like to see high return on equity. And then I start to do the rest. But on a weekly chart, most of the banks haven't broke out to all-time highs. The brokers have. But you can see this bank is a leader. It has already broken out to an all-time high. And you got some major accumulation stepping in, so maybe you get this on a pullback because it's, kind of anywhere around 35. But you remember the rule of three, so you had a consolidation, failed breakout. Consolidation, failed breakout. And then you have the third one, maybe it's a charm, I don't know, but it's just kind of a simple rule. And again, these are just wearing people out that cannot emotionally handle the shakeouts, the breakouts. So when I see this, I see all these failed breakouts, and then I see the fundamentals, and I see the accumulation stepping in on the third pattern. That is something that you want to pay attention to and probably hop on board. So I hope this was helpful. I hope everybody has a wonderful weekend, and there will be no video next week. Let me know if you have any questions.